now, in our foreign trade management paper, we have seen the meaning of foreign trade management, parties involved in foreign trade, global organizations who are monitoring the flow of trade. In our last class, I introduced you to the documents involved in international trade. A quick recap: we have the purchase order for the buyer, the commercial invoice and the packing list for the shipper, the bill of lading for the shipping line, airway bill for the airlines, the shipping bill and the bill of entry as documents for customs. Apart from these, we also saw a couple of other important documents such as the certificate of origin, the inspection certificate, the insurance certificate, fumigation certificate, ATA carnet and manifests. We have also seen the role each document plays in international trade. Moving forward, in our today's class, we are going to be speaking about the concept of balance of payment and its importance. We all know that countries transact with each other to derive mutual benefits. They do so in order to earn foreign exchange funds which will be used for meeting the demands of the domestic market as well as to invest for the future growth of the economy. The countries need to maintain the details of such transactions and monitor them regularly. The systematic record of all the monetary and economic transactions that one country does with the rest of the world is called as a balance of payment. It provides detailed information of the funds flow, as in what is the inward flow of fund as well as the outward flow. This helps the governments of the countries to plan appropriately the requirements to meet the domestic consumption as well as to plan for the future investments. It is something similar to our personal financial accounts. We have incomes in the form of salaries or business profits. At the same time, we also have expenses in our day-to-day lives. We have to manage and monitor the funds carefully so that we can meet our everyday expenses, at the same time save some money for the future plans. The governments similarly use the balance of payment as a record to monitor the flow of funds and plan the policies accordingly. Balance of payments are measured quarterly or annually by the governments. By analyzing the BOP, we can understand the economic status of a country. Balance of payments also provide very useful information to understand the trade relationships between the countries. That is, which countries have very strong trade relationships versus the others. It also helps the governments to formulate economic policies, meaning if the expenses through imports is higher than the earnings through exports, the governments will form new policies to limit the imports and therefore reduce the expenses and maintain a BOP equilibrium. In an international scenario, the balance of payment is a measure which determines if a country can be a strong economic partner. Also, the balance of payments help to understand the currency situation in the international finance. Transactions in BOP are recorded as credit and debit. The receipts are recorded as credits, which include exports, foreign spending in domestic market, foreign investments in domestic market. On the other hand, all the payments are recorded under debit, which include imports, foreign aid, domestic spending abroad and domestic investments abroad. A balance of payment deficit occurs when the country is importing more products than it is exporting. A deficit is not a favorable situation for the government as it reduces the funds flow to the government. If the trend of the deficit continues for a long time, the government may have to sell its assets in the form of land or commodities to pay off the debts. On the other hand, if the exports are higher than the imports, it is referred to as a balance of payment surplus. A surplus is a favorable situation for the government as it gives them more funds flow. A large domestic market protects the country from exchange rate fluctuations. A surplus also enhances economic activity as more people are involved in production which is meant for export. Now let us look at the elements of the balance of payment. The BOP has three major elements, namely the current account, the capital account and the financial account. The current account monitors the transaction of the goods and services between the countries. The capital account monitors the transactions of assets, while the financial account monitors the transactions of investments and intangibles. Current account. This account monitors the flow of goods and services between countries. It covers all the receipts and payments made with respect to goods such as raw materials, manufactured products, engineering, etc., and services such as tourism, transportation, stocks, royalties from patents and copyrights. The capital account transaction includes the purchase and sale of non-financial assets like land and property. It also includes the purchase and sale of fixed assets by migrants moving in and out of a country. On the other side, the financial account, the funds that flow to and from other countries through investments like real estate, foreign direct investment, business enterprises, etc., is recorded in the account. It measures the change in foreign ownership of domestic assets and domestic ownership of foreign assets to understand if a country is selling or acquiring more assets. As we have seen, the balance of payment is an integral part of economic stability of a country. The BOP is also used by the governments to formulate new economic reforms and policies. Any imbalance may lead to a situation of crisis which is not a favorable condition. Let us understand this with the example of India's economic crisis. In the year 1991, India slipped into some major economic crisis due to the BOP. The major reasons were sharp increase in imports. India as a country imports crude in order to meet the demands and requirements of some major industries. But due to the Gulf War that was happening at that point in time, the prices of crude had increased drastically, and therefore government's expense towards the import of crudes had also increased substantially. On the other side, due to the industrial development that was happening within the country, India was also importing many products such as capital goods and intermediary goods for repairs and maintenance. This also added up to the government spending towards imports, whereas India's export scenario was not much favorable because many countries in the world had slipped into an economic recession and thereby reducing India's exports. This imbalance between imports and exports led it to India's BOP crisis. The government at that point in time needed to save the economy and put it back on track. In order to do so, as a temporary solution, the government reached out to the International Monetary Fund, who oversees the BOP of all the countries globally, and took a loan with gold as collateral. On the other side, the government also had to think about permanent solutions so that the economy can be put back on track and towards growth and development. For this, the government came up with the economic reforms popularly known as the Liberalization, Privatization and Globalization. The three key initiatives undertaken by the government to put the Indian economy back on track and also looking forward for its growth and development. Until the year 1991, the Indian economy was a closed economy, meaning the government was controlling the domestic market with policies such as the Industrial License Raj, and they were controlling the international markets with very high restrictions and trade barriers. Under the three new key initiatives such as liberalization, privatization and globalization, the Indian economy was opened up. Under liberalization, the government went ahead and reduced the restrictions and trade barriers with the international partners and thereby allowing more foreign trade to flow in within the country. Under privatization, the government abolished the stringent regulations in the domestic market such as the industrial license Raj and also allowed more private participation in the business. And under globalization, the government opened up the economy to mergers and acquisitions, also foreign investments in order to help the economy grow. Now let us understand the definition of the new reforms that had taken place: liberalization, privatization and globalization. Liberalization refers to the relaxation of government restrictions in areas of trade policies. When government liberalizes trade, it means it has removed tariffs, subsidies and other restrictions on the flow of goods and services between the countries. Privatization refers to the transfer of assets or service functions from public to private ownership. Privatization was achieved by the sale of shares of public sector undertakings, disinvestments in public sector undertakings, leasing, contracting, etc. Globalization implies integration of the economy of the country with the rest of the world. It is done by opening and planning to expand the business with the world by buying and selling goods and services from or to any country. Now let us see the advantages of liberalization, privatization and globalization. Liberalization leads to new trade policies, reduction of tariffs and better environment for foreign trade. Privatization increases the efficiency of the company's performances, increases competition in the domestic market and also leads for innovation. On the other hand, globalization increases the scope for mergers and acquisitions, joint ventures with best-in-class companies and therefore offer better products for the demands of the local market. It also increases the opportunities for employment and allows free flow of capital and technology between the countries. With this, we conclude the balance of payment topic and I will see you in the next.